Do you know that over 90% of crypto traders lose money because they ignore risk management? If you want to survive and succeed in crypto trading, risk management is a must. Hey everyone, I'm Coach Collins, a crypto trader and a digital entrepreneur. On this channel, I'll teach you how to trade profitably to avoid costly mistakes. If you are serious about growing as a trader, hit that subscribe button and turn on notification. In today's video, I'll break down everything you need to know about risk management in crypto trading, what it is, why it's important, and the 15 best risk management strategy to protect your capital and minimize your profit. Let's get started. Before we dive in, make sure you like this video so YouTube shows it to more traders who need this knowledge. Now, what is risk management? Risk management in crypto trading is a process of minimizing your potential losses and maximizing potential profits. It involves the use of various strategies to protect your trading capital from large losses. So this means it's very easy. So risk management is just protecting your capital, minimizing your risk. Of course, in crypto trading, you lose money and you also make money. So I'm here to guide you on how to minimize your risk and then maximize your profits. So that's what risk management is all about. Now, why is risk management important? Crypto, the first reason why risk management is important is that crypto is highly volatile. Price can swing wildly in minutes. That is, crypto is not stable, so price moves rapidly. It changes over time. All right, it's not stable, so that's why you need a risk management. Then the second reason is unexpected market events such as news, regulations, or whale movements can cause sudden crashes. For instance, a news might drop leading to the downfall of Bitcoin or rest of cryptocurrency. That's what it means. Okay. So the third reason why we use risk management is to preserve our capital. That is preserving your capital. Without risk management, a few bad trades can wipe your entire account. Yes, without certain risk management like stop loss and the rest, a few mistakes can wipe your entire account. So, and this is actually the main reason why we use risk management to preserve our capital. Now let's go straight into the best risk management strategy every trader must follow. So the first risk management is position sizing. That is, how much of your capital should you risk per trade. Now the rule in this risk management is never risk more than 1 to 2% of your trading account in a trade. All right, so what do I mean by that? Let's assume you have a $1,000 account and you risk 2%. That is, you are risking $20 out of that $1,000 you have in your account. That is, you are risking $20 per trade. I don't know if you understand what I meant. Like, I mean, if you are trading with a $1,000 account and this position sizing says don't risk more than 1 to 2% of your trading account, meaning you should not risk more than 1 to 2% of your trading account. That is, if you are trading with a $1,000 account, you should not risk more than $20 per trade. That's what it means. All right, that's what position sizing is all about. Don't risk more than 1 to 2% of your trading account. So the second risk management here we have here is stop loss orders. That is setting of stop loss orders. Your best protection against this is your best protection against massive losses. A stop loss order automatically closes your trade if the price hits a certain level. Example, if you buy Bitcoin at $30,000, you can set a stop loss at 29,500 to limit your loss. All right, so this is just setting a stop loss order so that the market won't lose more than expected. For instance, like I said in this in the first one, position sizing, that is, you should not risk more than $20 per trade. Now your stop loss should now be when setting your stop loss. For instance, you funded your account with $1,000. When setting your stop loss, you should set it around $20. Yes, so that you won't lose more than $20 in your $1,000 account. Setting of stop loss is very good in risk management. This is like the best risk management. Never trade without a stop loss. I have made these mistakes countless times and I've lost a lot of money because I'm an experienced trader, so I don't make this mistake anymore. So never trade without a stop loss. Always set a stop loss to your trade. I use a standard stop loss of 30% when I trade, depending on my analysis. It's actually depending on my analysis though, but my standard stop loss is 30%. So never trade without a stop loss. Now the third one here is take profit orders. Take profit orders. Secure your profit before the market reverses. A take profit order sells your asset once it reaches your target point. Now this means you should set an order if market reach this amount of price, the market should close your trade in profit. That's what take profit orders mean. So you should learn how to you should not be greedy. So most of the traders who lose their money they are always greedy. They make analysis, the market goes their way, but they don't take profit expecting the market to go higher, higher, which will not happen. So the market then reverses to hit their stop loss or leave them in a loss. So you should always learn to set take profit orders and also a stop loss order. So let's proceed. The fourth one is risk to reward ratio. Now always aim for a higher risk to reward ratio. What do I mean by risk to reward ratio? So let's say your risk to reward ratio is, if your risk to reward ratio is 1:3, that means you are risking. For instance, let me use a price. Let's say your risk to reward is 1:3, and in a trade you are risking $10 in order to make $30. That's what it means. You are risking $10 to make $30. Now this risk to reward ratio is very important. It's very important. It doesn't matter the number of trade you lose. What matters is your risk to reward ratio. For instance, your risk to reward ratio is 1:3 and you entered 10 trades. Now in those 10 trades, you lost 6 trades. That means, let's say you are risking $10 per trade. You're risking $10 per trade. Your risk to reward ratio is 1:3. That means you are risking $10 in order to make $30. So now you risk $1. You risk $10. You took 10 trades and you lost 6 of the trades, and you won 4 of the trades. Now, when you are risking $10 per trade, you lost in those 10 trades. In those 6 trades you lost, meaning you lost $60. Then the remaining 4 trades that you won with the risk to reward ratio of 1:3, that means you made $120. Can you see the difference? It doesn't matter the number of trades you lost, it depends on the quality and your risk to reward ratio, the quality of the trade. So that's what this risk to reward ratio is talking about. Let me explain again. Let's say I'm still using that $10. You took 10 trades and you lost 6 and won 4. The amount of trades you took is 10, but you lost 6 out of those trades. That means you lost 6 trades and then you won 4 trades. So your risk to reward ratio is $10. You are risking $10 per trade. Now, in those 6 trades that you lost, if you calculate it, $10, $10, $10, that's $60. Then the remaining 4 trades that you won, that is, you made $30 in those 4 trades, that is $120. Can you see that you have multiplied your losses? You doubled your loss when making the profit. Do you understand? You made more money irrespective of you lost 6 trades, but you made more. That's what this risk to reward ratio is talking about. All right, so the next one is break even point. This is the safest way to avoid losses. When your trade move in your favor, you move your stop loss to your entry price. Now, this is very easy. This is very, very easy. I already made a video about this break even point. I made a video, so you can go and check the previous video and watch it very well. Now, let's say, for instance, you bought Bitcoin at $97,000. That's when you bought Bitcoin, and the price rises to 97,500. Now you're going to move your stop loss to 97. You're going to move your stop loss to that 97,000. Now, even if the price drops, you won't lose any money. Even if the price go down below that 97,000, the market is going to take you out. The trade is you'll be stopped out of the trade, and you won't lose any money. So that's it. The main reason behind this break even point is just to protect your capital. You are not losing anything in this strategy. You won't lose a dime when you use this strategy. So I often use it. I use this strategy often, and I advise my students to use this strategy as well. Whenever we take a trade and the trade moves to our favor up to 30% or 20% above our entry price, we move our SL to our entry price. So even if the trade goes against us, the market will stop us out. We're going to be stopped out of the market without losing any money at all. So this break-even point is very, very essential. It's very, very important. Once you learn how to set break-even points, I promise you won't lose more. You won't lose the kind of money that someone who trades with only a stop loss lose. All right, so let's move to the next one, to the 6th one, which is dollar cost averaging, DCA, the best long-term strategy. So this strategy is about invest a fixed amount regularly, no matter the price. Example, in this strategy, instead of you investing, let's say you have a $1,000 you want to put in a trade, but instead of you investing that $1,000 at once, you just keep investing it gradually. For instance, like I wrote in my example, instead of you investing $1,000 at once. You invest $100 every week in Bitcoin. You can also use these strategies. These strategies is more often used in sports trading. Yeah, is often used in sport trading. So instead of investing your $1,000 once, you can just keep investing it gradually. That's how this dollar cost averaging strategy works. So let's move over to the second one, which is diversification. So it says never put all your money in one coin. Spread your investments across different crypto assets to minimize risk. Example, instead of putting $1,000 in Bitcoin, you could invest $400 in Bitcoin, $300 in Ethereum, $200 in a promising altcoin, and keep $100 in a stable coin. So this is very easy. It's more often used in sports trade. So instead of you to invest your whole money in a particular coin, hoping for the coin to rise, you either invest it in different coins. All right, so is this one is very easy. It's more often used by sports traders. All right, so we'll move over to the next one, which is leverage control. Avoid the biggest killer in trading. Low leverage, less risk. So leverage is plays a role. Leverage plays a huge role in your trade. All right, the higher your leverage, the higher your risk. The higher the leverage you use, the higher profits you make, and also the higher losses you make, as the case may be. All right, so I just advise my students to use less leverage and more of their capital. You better use less leverage and more of your capital. All right, so you don't, especially if you are a scalper, you don't use, though scalpers use high leverages, but it's not advisable. All right, so in my example, I said if you're a beginner, don't use more than 2 to 3x leverage. Avoid 10x, 20x, or 50x leverage, as it can wipe out your account. So as a beginner, don't use high leverage. All right, those people that use high leverage, like I use high leverage when I want to scalp, or when I am sure of a particular trade. That's when I use a very high leverage. All right, but you as a beginner, don't use high leverage. Okay. Effects of leverage, it amplifies your losses and your profits, and it also makes your liquidation price to be close. When you are trading, it makes your liquidation price to be close. A lot of people get liquidated. Liquidation is just the total loss of assets. When you get liquidated, the whole money you used in that trade will be wiped out. So that's why it's advisable to use low leverage. So moving over to the next, which is number 9, only risk what you can afford to lose. Never trade with money you need for rent, food, or emergencies. Crypto is volatile. Always be prepared for losses. So this is the first risk management you should know as a trader. Never risk what you can't afford to lose. Only risk what you can afford to lose in trading, because there are risks. Crypto trading is risky. Yes, trading is risky in a whole. All right, so you don't put the money meant for your feeding, your rent, and the rest. You just put the money. I advise my students, put 10% of your monthly income into trading. So let's say you make $1,000 per month. Just put $10, or maximum put $100. So you won't, even if you lose that money, you won't feel it. You won't feel it that much. Your emotions won't be involved in that money. All right, so let's move over to the next one, which is called hedging. A smart way to protect your portfolio: open an opposite position to reduce losses. Okay, this hedging is just is mostly used in when you are on a spot trade. Let's say you bought Bitcoin, for instance, and you are expecting the Bitcoin to move high so that you can sell and take your profits, but you notice that Bitcoin is going down. That is, you are losing as a spot trader, you're losing at the moment. So now what you do is to move over to the futures market and then short Bitcoin. All right, so as you're shorting the Bitcoin, you are making more money. All right, while you are waiting for the price of the Bitcoin to move above the spot order you placed. Okay, so that's it about hedging. Let me explain again. Hedging is just about is in collaboration with spot and futures. All right, when you buy a coin in spot market, because the only way you make money in spot market is by buying low and selling high, but in futures you can buy and sell and make profits either ways. All right, so when you buy a coin in spot trade, you're expecting the coin to move above your the price you bought it, okay, in order for you to sell to make your profit. But you realize that the coin is actually going down. So all you need to do is to move over to the futures market and short that coin Once you short that coin, that at that moment that the coin is losing value, you're making money in the futures market while you are waiting for the coin to actually go above the price you bought it in the spot market. So that's it about hedging. We'll move over to emotional management. All right, so emotional management, there are two emotions that are involved in trading, which is just fear and greed. Fear of missing out and greed. Now, what do I mean by fear? Fear is when you are afraid to, let's say you are afraid to take a signal, you don't know the next move of the market and you are panicking, you are fearing, you don't know if you enter the market whether it will go against you or not. And then greed is when you are on profit and you feel like the profit is not enough for you. Always learn to take profits in crypto trading or forex trading, any trading at all. Learn to take profits. Don't be greedy. All right, so traders lose a lot of money using this with these two emotions I mentioned, fear and greed. Right, just stick to your plan. Don't let your emotions make decision for you. You are the one to make decision in the market, not your emotions. All right, so avoid fear and greed. Trust yourself. Once you analyze the market, trust your analysis. Enter the market with confidence and you make money. Then set a take profit. Avoid greed. Is not advisable in trading. All right, so just take profits, whatever, whether small or big. Just remember to always what, take profits. So moving over to the next, we have the number 12. We have over trading. Now, too many trades equals to more mistakes. Right, learn not to over trade. All right, stop over trading. Don't take trade. Maybe you saw a signal and you feel that okay, that signal is actually good, and you just take the trade without confirmation or without your own analysis. Don't take too much trade. Remember, the number of trades you take doesn't matter. What matters is the quality of the trade you are taking. All right, so don't over trade and do not revenge trade. Once you don't see an opportunity in the market for you to trade or for you to make money using your strategy, avoid the market. Don't trade at that moment. All right, so just don't take too much trades. A very good trade, I can advise you to take a trade once a day. So far the trade is a very good trade, and it has a very high risk to reward ratio. So you just take the trade and take your profit for the day and rest as a day trader. All right, so moving over to the next, we have using trailing stop loss, locking in profit while letting your trade run. A trail stop moves as the price moves in your favor. Now this is just like, let me see, this is similar to break even. Now what do I mean by it's similar to break even? So let's say you bought Bitcoin at $100,000, and now Bitcoin is at $102,000. Now you set a trailing stop loss of $101,000. That means you are securing $1,000 already. So even if the market take you out of the market, even if the trade, you are being stopped out of the market, you are going to still have your $1,000 profit. I don't know if you get what I mean. Let me explain using another coin. For instance, you bought Ethereum at 1,800. Now you set a trailing stop loss of $50. Now if the price rises to $2,000, you move your stop loss. Instead of, now listen, in break even, you move your stop loss to your entry. Now your entry here is $1,800, but if the price rises to something like $2,000, you move your stop loss to $1,950. Now you are securing from some dollars ahead. All right, so even if the market comes back to your entry point, the market won't even reach your entry point. It will just stop you out and leave you in profit. All right, so the 14th strategy is exposure limits. Don't risk too much at once. So what this means is, the rule is never invest more than 50% of your portfolio at once. Now example, if you have $1,000, keep at least $500 in stable coins. Now what this means is, let's say you have $1,000 in your trading account. You don't just use the whole $1,000 in a trade. Learn to break it down. All right, so you can just use 50% or 20% or sometimes 10% of your account. Don't use the whole money you have in your account to trade or buy a particular portfolio or buy a particular coin. All right, so you just have to use the highest amount you are meant to use is 50% highest. So I always advise to use 10%. So but the highest you can use in your portfolio is just 50%. You can decide to keep the rest in a stable coin, or use it to buy some assets, a stable asset. All right, so the 15th one, the last but not the least, is what? Using a trading plan. Define entry, stop loss, and take profit before entering a trade. This means you should just use your strategy. Don't use people's strategy. Believe in yourself. Use your own strategy. Stick to your plan. No matter what happens in the market, stick to your strategy. Now, regular review on your trading plan. You should review your trading plan. Always improve and adjust your strategy based on the market condition. You don't just relax because you have a trading strategy already. Learn to adjust it, advance your trading strategy, and always stick to it. Depending on the current market condition, you might try to advance your trading strategy, right? you advance your trading strategy. Don't use people's strategy. Believe in yourself, use your own strategy. Don't change your strategy. No matter what happens, stick to your strategy. Rather, you enhance your strategy. All right. Now, here are the common mistakes you are meant to avoid. All right. So you avoid over trading. Don't take too much trades, because too much trade leads to lots of losses. So you avoid taking too much trade. You avoid over trading. Now, ignoring stop loss. Always use stop loss in your trades. These are the important things. These are important things you should know. These are common mistake people make, and they don't actually see it as mistakes, but they are mistakes behind their losses. Some crypto traders or some traders out there make these mistakes daily and they don't realize. So the next one is over leveraging. I've already talked about it. High leverage is equal to high risk, low leverage is equal to low risk. So in order to minimize your risks, you should use a low leverage. So the next one is chasing losses. Accept losses and move on. Don't revenge trade. What do I mean by revenge trading? Let's say you enter the trade now, and you are okay, you lost the trade, and you are that's when your emotions comes in, and you try to gain back the money immediately, and you find yourself losing another trade. All right. So it becomes piled up, the one you lost before and the one you lose now. So don't revenge trade. Accept it as losses is part of the game. Losses is part of trading. So accept losses, don't revenge trade. Accept losses and move on. So now avoid FOMO, which is what? Fear of missing out. I've already said this before. Don't trade with your emotions. Don't let your emotions decide for you. Rather, make your decisions yourself. All right. So don't chase pumps. Don't chase pumps or enter trade based on hype. Do you understand? I say don't change pumps or enter trades based on hype. Maybe, what do I mean by this? A lot of people are saying about this coin. Though sometimes when people are talking about a particular coin, that coin tends to move high or low depending on the kind of news they are talking about. Okay, but don't trade based on pumps or enter a trade based on hype. Rather, stick to your trading plan and risk management rules. Do you understand? All right. So now, if you have watched this video to this level and you haven't subscribed to this channel, you are I don't know, you are actually playing. So you need to subscribe to this channel, like this video, and then join my free crypto group where I drop free signals. And you can also register for my VIP class, where the trading fee is actually 100,000, but I'm on a promo. The first 10 people gets the trading mentorship or course for just 20,000. After the first 10 people, it increases to 30,000. After the first 30 people paying that 30,000, it increases. So it goes like that till the end, till it reaches the normal price, which is 100,000. All right. So make sure you join my group. I'll be leaving the link in the description, so check the description of the video. I'll be leaving the link there. Make sure you like this video, subscribe to this channel, and that's it. So let's continue. Risk management is the key to long-term success in crypto trading. If you apply these 15 strategies, you will protect your capital and trade with confidence. If you find this video helpful, like and subscribe, turn on the notification for more crypto trading content. Drop a like, drop a comment below if you have any questions. See you in the next video, guys. So I actually have a video. I actually prepared a video about how to use the Bybit application, so you can just watch the video and also sign up with my partnership link, where you'll be given a free $20 gift to trade. That is when you sign up with my partnership link. I'll be leaving all the link in the description, so always remember to check the link in the description. I'll be dropping everything accordingly in the description of the video, right? So guys, like the video, subscribe to my channel, and see you guys in the other side.